Good afternoon, everybody. Welcome to the third episode in the Oregon Small Woodlands Association Forestry Taxation Series. This is our third episode of 7, and if you've been keeping track, last week Clint Bentz talked about how you are classified determines how you are taxed, and then today we're going to be talking about recognizing income. I'm going to post the link here in the chat soon, but if you have missed any of the other 2 sessions or want more of the slides from those previous sessions or handouts, I'll post the link to the OSWA website where you can access them. Before Clint gets started, a little bit of a Zoom tutorial. For those of you that are probably already experts, you probably don't need to listen to me anymore, but to get to the Q&A section, you can move your mouse or touch your smart device and you want to find the Q&A button. It should be right between participants and chat. And so if you have questions, you can put your questions in there throughout the whole presentation. Uh-oh, someone's not getting my audio. Hopefully it's just Bonnie. Anyway, other than that, please feel free to use the chat if you have any other issues like Bonnie is doing, and we'll try to help you figure out any problems you have. And Clint, if you are ready, I think that's all I have for today. Here's that link.
Great, Jeremy. Welcome, everybody. Let me go ahead and put up my screen here. So, Jeremy, can everybody see that?
Looks good, and I can hear you well, Clint.
Wonderful. Well, welcome back to the session. So, timber taxation for forest landowners. We've had a lot of conversation that has been going on over the these last sessions and in between. So I'm really excited about this and going forward. So we started off on March 9th talking just about the overview of timber taxation and about casualty losses. Last time we talked about how you're classified determines how you are taxed. And today we're going to be talking about reporting income. And so then going on to the future classes, we'll spend on April 13 deducting expenses, which we'll be talking about basis and if you are operating as a business, what kind of expenses you can deduct and how. We'll also be talking to those of you who are investors and are classified as other ways, how those expenses might get deducted or capitalized. April 27th, we'll talk about capital expenditures. So it'll be things like roads and equipment and things like that. And we'll also, I think, we'll be talking about reforestation on the 13th. So, but April, and we'll also be talking about repairs and maintenance on April 27th, which is a huge issue. A lot of changes in the law on repairs and maintenance the last several years. May 11th, we'll be talking about choosing a form of business and other tax issues. This is kind of some miscellaneous things that we were able to cover in the other sessions. And then finally, we'll finish up talking about our property and harvest tax programs. So today, week 3, this is the outline of what we're going to go through in the next hour. Then we'll have about a half an hour after that for questions and answers. So as we're going through the course today, if you have questions, go ahead and put them in the Q&A. And Tammy is going to be monitoring that, and some questions I think she'll be able to answer directly, and others she'll put together, and we'll have a discussion after I'm done with the course. So we're going to talk about capital gains, the sale of land and timber together when we sell the land and the timber with the timber on it. Then when you sell an easement, including a conservation easement on your property. Talk about lump sum sales, so transferring timber on a timber deed. Talk about 1031 exchanges, timberland, timber deeds. That's been an area of some controversy. So we'll talk about the rules and how that works. Pay as cut contracts, which are 631B. Then we'll talk about sale of logs, because that's what most of us do. Small woodland owners, we mostly sell logs. We don't just sell lump sum sales. And then we'll talk in particular about Section 631A, which is the election to consider cutting the sale or exchange. And that's the code section that we use to get capital gain treatment when we sell logs. And we'll finish up talking about sales of firewood and other forest products. And so today's all about how we recognize income. In the next session we'll be talking about the expenses. So capital gains treatment. So why do we care? So one of the things we'll be talking about is the difference between ordinary income and capital gains. Ordinary income is taxed at ordinary income tax rates. Capital gains are taxed at capital gains tax rates, which are lower than the ordinary income rates. And so generally, to the extent that we can, we like to have income tax as capital gains rather than as ordinary income. So capital gain is the tax that we pay when we sell a capital asset. So ordinary income is thing, if I give you my time and you give me money, or I give you my time, you give me money. So it's an exchange generally for services. Capital gains are when we sell an asset. So I own a house and I sell you my house and you give me money. That's a capital asset. We have a different tax structure for the sale of capital assets we do for wages and earnings from your business, things like that. Pension income, other types of ordinary income. Interest income, there's lots of things that are ordinary income. But capital gains is that it's when we sell assets. One of the reasons we like capital gains is there is no self-employment tax on capital gains, like there is either when we have wages and when the employer withholds our FICA taxes and Medicare taxes, or if you're self-employed, then you pay those taxes yourself. If we have capital losses, so we've had some losses in the stock market, or we've had some other assets that the values declined and we sell them and we have a loss, capital gains can offset those capital losses. Capital gains don't generally reduce our Social Security benefits. So if you retire and start drawing Social Security before your full retirement age, any earned income that you have reduces your Social Security benefits. So if we have capital gains income, does not do that. We also say all of our investment income and our passive income, which includes capital gains, are subject to the net investment income tax, which is a 3.8% surtax that's put on top of our normal income tax. So I've got a tax bracket here. I've got some in your materials as well. I hope you received the materials and were able to either print them out or have them at hand. But this is a bracket that just shows, so on the far left side, we have the ordinary tax rates starting at 10%, going up to 37%. And then beside that, I've got the capital gain rates, which start at 0. There's 3, 0, 15, and 20. Capital gain rates pretty much track with the individual income or the ordinary income tax rates. But the capital gains sit on top of the ordinary income. So actually how we compute this is we look at your taxable income, then we subtract the capital gains from that taxable income, and that determines what your tax bracket is for ordinary income. It also determines where we start with the capital gains. So for example, so if you're married filing joint, you're at the 12% bracket and a 0 capital gains bracket up to basically $80,000. So if we looked at your taxable income and your taxable income was $100,000, but you had $50,000 of capital gain income. So you had $50,000 of, so we take our total income, taxable income, $100,000, we subtract the $50,000 of capital gains. So you have $50,000 of what we call ordinary income. And that would be taxed the first $19,000 at 10%, and then from $19,000 up to $50,000 would be taxed at 12%. And then from $50,000 up to $80,000, you'd be in the 0% capital gain bracket. And then from $80,000 to $100,000, you'd be in the 15% bracket. So that's how those two things do together. We take your taxable income, subtract off the capital gains. That determines what your ordinary tax brackets are. And then that also determines where we start with the capital gains brackets, and then you move up from there. So you can see for married filing joint, for individuals, and also for trusts. So trust tax brackets are much, much lower. So if this is a challenge, many tree farms, they set up and they want to be owned in a trust. And the problem with trust is most of our income we like is capital gains, but even capital gains or ordinary income, you can see down in the far right-hand corner, you get to the 37% bracket, that top tax bracket, at $12,950 in taxable income in the trust. You don't hit that top tax bracket if you're married until you have $622,000 of income, or if you're single, $518,000 of income. We also hit that 20% tax bracket at that same $12,950 income. So trusts are not a great entity or vehicle to own timberland. Now, I'm not talking about a living trust for estate tax purposes, but if you intend when you pass on that your property will continue to be owned in trust, we may want to think about other forms of ownership, which we will be talking about when we come back this fall with a class on estate taxes and estate planning. All right, so capital gains is a good thing. We want to move that in. So a lot of what we're going to talk about here today is when is income from a tree farm ordinary and when is it capital gain. So if we sell the land and the timber together, so we're going to sell the land which has timber on it. So generally in most states, including Oregon, standing timber is considered part of the real property. So if you sell the property and it has timber on it, that entire sale price is basically treated as a sale of real property, and it is all eligible for capital gain treatment. Now, if you did reforestation on the property, so you did some clearing, you planted trees, and you took a reforestation deduction, which we will talk about next time we get together. So rather than capitalize those reforestation costs, you elected either to deduct them in the current year or you deducted them over the 7-year period. So we've taken that deduction and you sell the property within 10 years of doing that reforestation, then the deductions that we took for reforestation get recaptured as ordinary income. So basically you have to give the money back or it comes back as taxable income if you sell the property. So that's something to think about. If you buy a piece of property and you reforest it, or you have a property and you reforest it and you're thinking about selling it right away, you may not want to take the reforestation deduction because you're just going to have to pay it back later. Timber and land is part of your personal residence. So if you have, let's say you just have 10 acres, has your house on it, and basically that 10 acres is basically just a park. It could be 40 acres. So it can be any amount. There's no limit on the number of acres, but the reality is here, the issue that the IRS is going to look at is, did you treat it as part of your personal residence? And so if basically you bought it and maybe you did some thinning or something, all the work that you did out there was to basically to beautify the place, build some trails through it. It was something you used as personal use property. You never really intended, you don't hold it as an investment. You basically, it's all part of your residence. We do have this ability when we sell a principal residence, if you've lived in it for 2 years out of the last 5, to not have, to basically be able to exclude from your income $500,000 of gain if both you and your spouse have lived in the property as your personal residence. And so many people, if they're looking to sell, try to, this is a tax provision that they look at, is Code Section 121, and try looking at the property as part of their principal residence. If it's a mixed use property, so it's part personal residence and part investment property, then we basically have to allocate between the part that goes to your principal residence and the part that is the part that's investment property. We allocate the gain, we allocate the cost between those two. All right, so we're on page 4 in the outline now. So if we have mixed use property, then we just have to allocate both the sale price and your cost basis between the residential part of the property and the investment part of the property. We do this with farms all the time. So somebody has a farm and they've got their house on the farm and they sell the farm. The part of the sale price that's the residence and their garage and all that part of the property that is treated as a principal residence, that part of the gain that's allocated to that is subject, we basically get to eliminate up to $500,000 of gain. The remainder of the property is considered business property because it's farm, and that property basically pays tax. You pay tax on the gain on that part. we're going to talk about 1031 exchange a little bit later. The investment part of the property is eligible to do 1031 exchange for, to roll that gain over into new investment property. But the personal residence part is not eligible for 1031. So there's many times where we split the sale and we basically realize we've got a residence and we have the investment or the farm or the tree farm property, and we basically allocate gain between those two parts. And that's the typical way that it's handled. If you're trying to treat the entire property as part of your principal residence, you need to really make sure that your facts line up with what you're trying to claim, because the IRS may challenge that. And there's a number of factors, some of which I've included in the outline, but that's something you'd certainly want to be planning for years before you sold the property so that everything lined up for you. If we do have that sale, basically we just have to allocate the basis between those two things. And so, basically if you built the house, of course, the cost of building the house, that would be on the residence part, things like that. So they're fairly obvious. We report, if we sell land and timber, we report it on Schedule D. If it is investment property, we report it on Form 4797 if it's considered business property. So if it's considered business property, you're taking business deductions, then it's the sale goes on the Form 4797. When we sell the property, we can deduct our cost basis that's remaining in the property, including any remaining depletable basis in our timber. So if we've allocated basis in timber, all that basis, the basis in land, the basis in the timber, basis in all the improvements, all that gets all added into our basis that we have, and it reduces the amount of gain that we have to pay taxes on. So what we pay taxes on is the difference between what you paid for it and what you sell it for. We can also include your expenses related to the sale. So you got to do some appraisal work, some fixing up expenses, things like that. All of that goes into broker fees, all those kinds of costs get added to your basis and reduce the amount of capital gain that you have on the property. Easements. Those of us who own these properties, we have all kinds of easements. So we have easements for power lines, easements sometimes for pipelines, for cable, for all there's all kinds of easements that go across our properties. Sometimes we'll sell an easement for road access. So somebody wants to come across our property to get to their property. And so we have a roadway and we sell an easement so that that person that's basically an easement is the right to cross or the right to use that part of the property. We're not transferring fee title, but we're transferring the right, and generally it's a right in perpetuity. So anytime we sell a permanent easement on the property, that's treated as a sale of real property. Now, if we just have a limited easement, so 2 years, 5 years, something like that, that would not be considered a sale of real property. That would be more like rent. In fact, they're basically renting that space for a short period of time. And so the sale from a short-term easement would be ordinary income. But if you sell a permanent easement, that's capital gain. We've got 3 options for how we allocate basis to the sale of an easement. First one is we just treat it like it's a leasehold. So treat it like it's a rental, even though we report the capital gain, we don't allocate then any basis to it. We just pick up the entire easement in our income as a capital gain. We don't allocate any cost basis to it. The second one is that we treat the easement as a sale of land, the sale of the land that's directly affected by the easement. The thing I like to think about is like the road easement. And so let's say the road easement is going to go across one part of the property, and it's going to take 5% of our land is going to go and is in that road easement. And so we could then take 5% of our cost basis in the land and apply it to that easement. In fact, we've sold 5% of the land, even though we can still use the road ourselves, we have sold this easement across. And so the easement only affected that 5%. So we can use 5% of our basis. So it's a pro rata share of the basis based on the fraction of the ownership that we own, is affected by the easement. The third one is we treat it as basically an open-ended sale, or an easement affecting the entire property. So I think of these as like a conservation easement, or an easement of even that road easement, which may allow us to now maybe log the property. So maybe we share the cost of building the road with the neighbor. We give the neighbor an easement across it, but having that road there now gives us the ability to be on the property year round, where before we didn't have that ability. And so that easement now benefits the entire property, or it affects the entire property. In that case, we can take our cost basis and offset it against the sale price dollar for dollar until all of our cost basis is used up. So if I've got $100,000 of cost basis in the property, including so $100,000 of cost basis in the property, and let's say I sell this easement for $10,000, I could then apply $10,000 of cost basis to it. It's not a pro rata because it's involved in the whole property, so that that gain that I recognize on that is nothing. It's zero. You report it, it reduces your basis, but there's no income taxes to pay. So those are the three options, and really you can choose whichever one fits your fact pattern the best, and also your tax situation for the year. Maybe you have some capital losses and you don't mind having a capital gain to eat them up, and so you don't want to apply any basis. You have that ability. Let's look at the specific case for conservation easements, because these are becoming more and more prevalent. We've got so a conservation easement is an easement. It's a permanent easement that is placed on the deed and generally restricts, it's a deed restriction, restricts what we can do with the property. So generally there's some restrictions against development and other things on the property. Maybe there's a particular management regime. In any case, when we put a conservation easement on the property, the value of the property declines generally, because we have given up some of our rights. And so there's three basic forms that when we do that, we can either give up, we can put that conservation easement on. Generally, conservation easement is held by a tax exempt entity, a land trust, or the Department of Forestry, or there's other groups that hold these easements. And so we can do that as a donation. And so we have this, we get a charitable deduction for the difference between the fair value of the property before the easement and the fair value of the property after the easement. So it's very similar to what we do with casualty losses. We look at the value before, the value after. This is done with qualified appraisal, and we can take a charitable deduction for that donation. We can also sell those easements. In fact, some land trusts are out there actively buying easements on what they consider threatened lands. And so they're willing to pay you for the value of that easement and pay it fair value for it. And so in that case, that easement, because it's a permanent easement affecting the entire property, that's treated as a sale of the real property. And if the easement generally affects the entire property, you can offset your basis dollar for dollar against that easement up to the limit of your basis in the property. The third one is actually generally most common, where they will give you some money, but not, maybe they'll give you 20, 30, 50% of the value of the easement. And so let's say that by putting the easement on the property, the decline in value is $1 million. And they're going to willing to pay you $500,000 for that easement. And so you have part donation, you have a $500,000 charitable contribution and a $500,000 sale. So in that case, a bargain sale, we basically have to allocate our basis pro rata between the two parts. So if in fact the sale part and the donation part are equal, then we would allocate our basis equally to both parts. So it reduces, so we end up paying more tax, and the basis that it gets applied against a conservation easement basically is just lost. It goes away, but we get a charitable deduction for the fair value of the easement. All right, so let's go on. So lump sum sales. So also known as timber deeds. So most timber in Oregon, at least on the industrial side, is sold under the form of a timber deed. So in mills, purchase, basically, most mills purchase the majority of their timber through timber deeds, longer timber, 3 to 5 year deeds. And then they only purchase open market logs from people like you and me to meet their excess demand. So that's one of the reasons why we see open market log prices fluctuate so much, because a mill will look ahead in their production schedule and say, okay, I'm going to have a shortage of logs. And so they run the price up until they get enough commitments to logs to come in to fill their need. And then they'll shut the price down again to kind of stop the flow. And so all the mills do this, but generally the open log market is very volatile. Price goes up and down all the time, but the timber deeds are the backbone. It's how most of the timber is sold here in Oregon. And many times timber deeds actually get a premium price because it gives more flexibility to the mill in terms of how they can manage their production through the mill. So a timber deed is an outright sale of standing timber for a fixed price. So we basically go out and mark the sale. We determine there's so many board feet there, and then they maybe even have a bidding process, and they decide the mills between them, or they compete against each other. And when it's all done, you pick the winner, and then they write you a check. At that point, the title transfers from you to the standing timber that you sold. Title transfers from you to the purchaser, to the mill, or to the other person who bought it. And that means if there was a fire the day after you sold it, there would be no loss to you, because they paid you for the right to go in and cut that timber. And if something bad happens and they can't get the timber out, it's their problem, not your problem. So it's a sale for fixed price, and the seller retains no risk of loss. It's generally written for a specific term: 1 year, 2 years, 3 years, 5 years, 10 years, 30 years. And then you go to Eastern Oregon, there's a lot of 99-year timber leases. So they can be as long really as you want. And they can contain other provisions like specifications on how the logging is to be done. They can do on reforestation, on road building. It could be insurance, all the things that you generally deal with in a logging contract or sales contract can also be included in the timber deed. And generally, all those terms are included in the deed. They pay you up front or in installments, and you get to deduct the depletion on your timber, your cost basis in your timber, based on the volume of the timber that's being sold. So if you're completely taking all the timber off the property, then you basically would you get back all your basis in the timber. If you're only selling a third of the timber, then you get back a third of your cost basis. So it's the depletion is based on the volume of the timber that's sold. We can add those sale expenses, and there generally are sale expenses in regard to a timber deed. There's a legal fees to draw off the deed. There's generally some appraisal work, some cruising work. Maybe there's some marketing work in getting the prospectus out, managing the sale, all those things. So all those sale expenses are also added to your depletion in terms of the cost basis. But these sales are they're a section 631B sale. Generally, if you're in the business of logging, which most people who put these timber deeds together, they are in the business of logging, because this is or raising timber, because this is generally more commercial type operations that do timber deeds. And so that's a 631B. It's reported in the Form 4797. If you're an investor holding this timberland, then the timber deed would just be reported on Schedule D. The sale of the timber deed would be reported on Schedule D. So it depends on the classification, whether this is a 1221 asset as an investor or a 1231 asset as a business. (1031) exchanges. 1031 exchanges are really cool, because 1031 exchange allows you basically to trade in your old property for new property. So you may not have thought about it, but anytime like you traded in your old pickup for a new pickup, or you took an old piece of equipment and you traded it in on a new piece of equipment, and they give you, the dealer gives you a trade-in price that reduces the purchase price of the new equipment. All that trade-in work was done under Code Section 1031. And so if you had bought a pickup and you paid, $60,000 for it, and you depreciated it to zero, and now the pickup's worth $40,000, and you traded in on a new $60,000 pickup, and so you're going to pay another $20,000 to the dealership. They're going to take your old pickup, they give you credit you $40,000 for that, you give them $20,000 worth of cash, and now you've got a new pickup. So 1031 exchanges basically allowed you to take that $40,000 gain that you would have had on the sale of your old pickup and basically rolls that gain into the new pickup. The Tax Cuts and Jobs Act of 2017 eliminated personal property from the provisions of 1031. So we can no longer trade in our personal property, our vehicles, our equipment, and get that provision anymore. So what that means is that if you want to trade in your pickup on your old pickup on a new pickup, is that you'll actually have two transactions now. You have the sale of the old pickup, and you'll have now a $40,000 gain if you depreciate it to zero. And then you'll buy the new pickup for $60,000. You have a $60,000 basis in the new pickup, which then you can depreciate or expense or whatever based on your business. But we still have the ability to do tax deferred exchanges with real estate. So we have the property that we sell, which is called the relinquished property, and we have the replacement property, which is the new property. So in order to qualify under 1031 exchange for real estate, both the property that we sell and the property that we buy have to be held for investment or for productive use in the trade of the business. So it can't be a personal residence, and it can't be property, but if it's not, it can't be personal property or personal use property. It has to be investment property or business property. The good news is that all property in the United States, all real estate in the United States, whether it's improved or unimproved, is considered like kind. So you can exchange a vacant lot for an office building in downtown Portland. You can change farmland for timberland. You can exchange any type of property for a strip mall or rental real estate. All real estate is considered like kind as long as it's located in the United States. You can't take property in the United States and exchange it for property outside the United States. A property outside the United States is not considered like kind, but all real estate in the United States is considered like kind. So we can do a 1031 exchange. We want to get out of our current property and get into a new property. We have gain on this property that we don't, on the property that we own. We don't want to pay taxes on it. We want to take the full sale price and reinvest it in a new property. We can do that on a tax deferred basis. That gain that we have in the current property reduces our cost basis. Gain we have in our old property reduces the cost basis that we will have in the new property. Good news here is that the standing timber on the property is included in that real property definition. And so we can exchange timberland and include the value of the timber in that 1031 exchange and acquire either other timberland or other types of real estate. And the gain that we have in the timber is treated as gain in the real property. So we don't have to segregate anything out if we're trading. If you have real estate in Oregon and you sell it and you want to acquire property in Idaho or Montana or Washington or California or someplace else out of state, the thing you have to be aware of is it states, it is a tax deferred exchange, but when the states have tracking in place, including Oregon, and so if you sell property here in Oregon, do a 1031 exchange for property outside of Oregon, you have to basically report to Oregon and continue reporting on that property until you sell it. Because when you sell it, Oregon wants to be paid for get taxes paid on the gain that you originally deferred when you sold that piece of property in Oregon. So if you trade it and you've traded it 2 or 3 or 4 times, and then 20 years from now you ultimately sell it, that gain that was on that original property you had here in Oregon The Oregon wants a piece of that, and most states, I think, have similar legislation in place. So if you are trading property, you're going from state to state, just realize that there will be some tracking provisions that are going to be required. Okay, timber deeds. So long time ago, this has been an issue for a long time. Ever since 1031 came into the code, people have wanted to exchange timber deeds for real estate. Said, well, look, the timber, standing timber, is considered real property, right? Under Oregon law. In fact, one of the seminal cases was here in Oregon. It was Oregon Timber Company, Oregon Lumber Company. They wanted to exchange timber deeds for other property. And it's a big court case. And basically they said, look, this is real property. I should be able to exchange it for other real property. And the IRS looked at it really hard, and they basically said, look, when you're selling a timber deed, what are you really selling? You're selling the right to cut the timber to somebody else. And so they say that if you give somebody 2 years, 5 years to come in and cut the timber, and then that right goes away, so that really kind of looks more like a rent or a lease than a fee interest in the real property. It's not a long enough term, it's not a big enough right for that to qualify as real estate. Yeah, we don't have any problem. You want to sell the timber while it's still attached, and you want to sell the land along with it, land and the timber together, that's obviously real property. But if all you're selling is the right to somebody to come in and cut that timber, that isn't a real property interest. And so the IRS has basically shot down almost all exchanges for timber deeds with for land. Some people have managed to do it, but basically they've done it and they just haven't been caught yet. So there are a lot of 1031 exchange people out there that are advocating for this, but the reality is the IRS basically has said, no, this doesn't work. But the IRS also said that a leasehold, so if you own an apartment building, or let's say you own, actually this is a great, so Seventh Mountain, in Seventh Mountain, people there, the Seventh Mountain was built on a lease. So the people that own the property underneath gave like a 99-year lease to a development company to come in and build the Seventh Mountain and all those things. So when somebody comes in and buys a unit there at the Seventh Mountain, they basically only buy the right to be in that unit until the lease runs out. I think right now it's somewhere around 30, 35 years it's left. And so you're basically at the end of that 30, 35 years, you have to give up the property because you haven't bought what you bought is the right to use it for the next period of time. The IRS has said that a leasehold like that, if it's got more than 30 years to run when you buy it, that is like kind of real property. So most tax practitioners, not in the code, but most tax practitioners, because the IRS has said in their arguments against timber deeds, is that they liken them to a leasehold interest. Said, well, okay, if you have a timber deed that will run for more than 30 years, that would qualify as like kind. So over in Eastern Oregon, the people have the 99-year leases. They're trading those leases, swapping them for other things, and that's not a problem as long as there's more than 30 years to run. Here in Western Oregon, it's really, really unusual to see a timber deed that goes that long, and an unrestricted deed. So, but that's really, I think, the only safe way to make an exchange of a timber deed for real property is that timber deed has to be an unrestricted deed that runs for more than 30 years. Okay, how do 1031s work? So the gain that you have on the property that you sell. So let's say you sell it for this amount and you have basis of this. You sell it for $1 million, you have basis of $300,000, you have a $700,000 gain. That $700,000 gain is deferred to the extent that the purchase price of the replacement property you acquire, equals or exceeds the sales price of the relinquished property. So if I sell this property for $1 million, I have to go out and buy another piece of property for at least $1 million. And it can be more than $1 million, but if it's less, I'm not going to be able to defer the entire gain. So the sale price has to be across or up, and the debt on the replacement property has to equal or exceed the debt that you had on the property you own. And so if you've got debt in this property that you own, the debt amount, you have to have a similar amount of debt equal to or more in the new property. So the way to think about this, if you get any cash out of the deal, or if the debt goes down, to get debt relief out of the deal, either one or both of those things are considered boot in the transaction. This is money that wasn't reinvested, and it's taxable, and no basis is allocated to the boot. So the boot is going to be taxable up until you've used up all of the gain. So we don't allocate any cost basis to the boot unless the boot exceeds your total gain. In which case, there's no reason to do the 1031 exchange anyway, because there's no gain to defer. You've taken all the money out, all the gain out in cash or in debt relief. So we have to, if we're going to roll the gain over, roll it over, then we have to go across or up to completely roll over the gain. We have to go across or up in sale price and across or up in debt, both of those things. In the old days, not all that long ago, 30 years ago, the exchanges had to be simultaneous. My dad was a real estate agent and he sold farm and land broker. And so they had these exchange clubs that he was part of and actually helped create, where they'd have brokers from around the state and they'd all get together and say, hey, I've got a guy that wants this property. And the other one says, well, I got a guy that has this property that he wants to get rid of. And so everybody would kind of throw their property charts down on the table. Then they'd start mix and matching and say, okay, this guy wants this property, but these two guys, this guy has something this person wants, but they both don't have what each other wants, but this person has what that person wants. So they would do 3-corner and 4-corner and 5-corner exchanges. They all had to happen on the same day. Very complicated. It was a lot of fun. These guys made a lot of money doing that work. And it was a great service to their clients. But actually the Starker family, they did a 1031 exchange, and they didn't do it all on the same day. And the IRS challenged it, and they went to tax court, and the Starker family won. And so the IRS, or the Congress, then changed 1031 to allow for non-simultaneous exchanges. And so today, the state of the art is you sell your existing property, that money goes into a qualified 1031 exchange escrow account, and then the seller, they've got 45 days to identify replacement properties that they want to try to acquire. And they've got 180 days from the date of sale to close on those replacement properties. And once they've finished acquiring the replacement properties, then the exchange officially closes. All that has to happen in the same tax year. Actually, it doesn't happen in the same tax year, but let's say you sold the property in November, then you'd have until May to finish up the exchange. All of that then would come back to November, so either the exchange worked or didn't work. So if you weren't able to close on the replacement properties, that we just treat it as a sale, or if you didn't replace all of it, then you'd have your boot or whatever, and so it'd all be taxed in that year. And so you basically many times have to put the returns on extension until the 1031 exchange is all completed. So that's generally how most of it's done today. There's exchange escrows, and most of the title companies have exchange escrow side of their business. And so you just say, I'm selling this property subject to 1031 exchange. They open up a 1031 escrow. Money goes in there. You've got basically 6 months to to close. And so most people are out, you're out shopping before you sell the existing property, so that you make sure you hit that 6-month window to close on the replacement properties. We can do a reverse exchange where you acquire the replacement property up to 180 days before you sell the property. So reverse exchanges work too. They're much more complicated. They cost a lot more money. There's all kinds of rules and stuff outside of what we're going to talk about today, but it is possible. So you've got the ability to buy something today, but you can't get your property sold, but you do want to roll that gain over. You can do it, but it requires an accommodator and a bunch of other things. So you need to talk to an exchange professional if that's what you're going to be doing. Exchanges are reported on the form 8824, like-kind exchange form. And so that's where you report all this information on it. So a very, very popular way of basically taking the entire sale price, rolling it over into a new property, rather than selling it, paying the tax, and then just rolling over the after-tax amount into the new property. Okay, pay as cut contract, 631B. So this one, you sell your standing timber, but you get paid as it comes out of the woods. And so you can do a timber deed. This can be done on a timber deed, but rather than get paid lump sum up front, just say, okay, I'm going to get paid $400 $1,000 as the timber is brought out of the woods. So why would you do that? Well, it's still you don't have to do the logging, the hauling. The person who's buying it is going to do all of that. But maybe you're not sure, or maybe the buyer isn't sure how much timber is there exactly. And so you get paid as the material comes out of the woods. The title does transfer at the time of sale, but you retain some risk of loss, because if all those trees burn down, you're not going to get paid because they're not going to bring anything out of the woods. And so we call this a sale with a retained economic interest. So you've got some risk of loss in this deal when it comes back. A U-cut Christmas tree operation, many of them, this is a pay-as-cut deal. So basically you go in, you give them 20 bucks, and they hand you a saw, and you go out and you cut your tree and you bring it out. That is a 631B. That 10 bucks that you paid for the tree is capital gain. It's a capital gain operation. We don't have to do any other computations. If you are selling it on the stump, and basically then the person who's buying it has to go out and harvest the tree and bring it in, then it's a capital gain. The amount that you receive, the gross amount you receive, is a capital gain. So you didn't sell them the cut tree, you sold them the tree while it was still alive and had them go cut it. So because the 631B is in the trade or business section, so that's a 1231 asset. So in order to do 631B, you have to have held the property for more than 1 year. The date of disposal is the date that the tree is cut. You report this in the form 4797, and again, any of your sale expenses can be added to the depletion amount. Now let's get to where most of us are. We're selling logs. We've talked about this before. It doesn't matter what kind of a taxpayer you are, logs are personal property, not real property. A standing timber is real property. You take a power saw to it, you cut it down, falls over, and now it becomes personal property. It's now severed. They're generally not considered a 1221 asset for investors or for personal use. So the sale is not a capital gain. When we think of a 1221 assets, these are investment assets. Would you invest money into a deck of logs? You wouldn't, because why? I mean, the deck of logs is declining in value by the hour, right? As it dries out and the bugs come, and so those logs are not something that are going to appreciate in value over time, and so they're not an investment. A log is not an investment. It's something that you need to get rid of before it rots and goes away. And so when a personal use, so if you're cutting trees on your residence, or you get treated as a hobby, this activity is a hobby, then you report this as other income on the front page of the 1040, net of your depletion, your harvest costs, and your sale costs. If it's personal use or hobby, you cannot deduct a loss. And so if what you get for the logs is less than your depletion, harvest, and sale costs, basically the loss is limited to zero. But you can elect 631A, which we'll talk about in a minute, to treat this as, you have a capital gain component to the sale. If you're an investor and you sell logs, you do the same thing. Report this as other income on the front page of the 1040, net of your depletion, your harvest, and your sale costs. But if you're an investor, you can deduct the loss, and you can all on the front page of the return, and you can also elect 631A, or you can elect 631A. Now, if you're in business, either passive or active business, you report the gross income you receive from the mill on Schedule C, and then you can deduct your depletion, your harvest, and your sale cost as a cost of goods sold on Schedule C. So if you're just selling the logs, you report your depletion and your harvest and sale costs on the Schedule C. But you can also elect 631A. So let's talk about this 631A. This is the election to consider cutting as a sale or exchange. 631A can be used by any type of taxpayer, regardless of your classification, regardless of your entity type. So 631A can be used by S Corps, by partnerships. It doesn't make sense for 631A to be used by C Corps because C Corps do not have capital gain treatment. All their income is just taxed at now 21%. Doesn't matter what kind of income it is, where it comes from, it's all taxed at 21%. So there's no differential between ordinary income and capital gains for a C Corp. For S Corps, partnerships, LLCs, and individuals, we have a reduced tax rate because all those entities basically pass their income through to their owners, and basically all that income ends up being reported on an individual's income tax return. And individuals do have those reduced tax rates for capital gains. So if we make a 631A election, we're basically electing to have that sale be treated as a sale of business property under Section 1231. So the Section 1231 provisions come into play, which means that we can't elect 631A if we haven't held the timber for more than a year. 1231 says that you can't use any sale of a 1231 asset before, if you haven't held it for 12 months, is ordinary income. It's only after you hold it for over 12 months is it considered capital gain income. That's different than 1221. So a personal use asset for investor, if you buy it and you sell it 2 weeks later, we have a short-term capital gain because it's capital asset, you're selling it. We have a short-term gain. You hold it for more than a year, then we have a long-term gain. 1231, there are no short-term gains for 1231 property. If you sell 1231 property before a year, you've held it for a year or less, it's just treated as part of your ordinary income. You don't get to apply Section 1231 until you held it more than a year. Christmas tree growers are eligible to elect 631A for the sale of their Christmas trees if it's a cut tree and it's more than 6 years old when it's cut. So if they sell a live tree or if they sell trees, cut trees that are younger than 6 years, you can't use 631A for those sales. But if the trees are over 6 years old when they're severed, then they can use 631A to have part of the sale be classified as a capital gain. In effect, the 631A election treats you as having two separate businesses. You're in the business of growing timber, and you're in the business of selling a timber product, which in this case is a log, but it could also be firewood. It could also be furniture. It could be other things that you're creating out of the log. But you're in two businesses. One is your business growing timber. The other is your business of selling a personal property, a log or something that's created from the log. So in 631A, basically the log seller, the person selling the product, buys the standing timber from the timber grower. So you're both of those people. So in effect, you sell the stumpage, one side sells the stumpage to the other side, and then that stumpage value, what you sold it for, that theoretical deemed sale, is capital gain for the timber grower. And then for the log seller, that what they paid for the stumpage is part of their cost of goods sold, along with the logging and hauling costs. And so basically the net effect is we take the stumpage value of the timber and we move it from Schedule C over to Schedule D or the 4797. So we treat that as long-term capital gain. So how do we do this? Basically, this goes to, we take all the timber that's harvested during the year, all the timber harvested during the year. We've got all of our scale tickets. We know exactly the species, the grades, the volume, everything we know about this timber. So we've done 100% cruise on what was done. And we take all that timber and then we value that as of January 1, still on the stump. Because that we basically treat it, we're selling the standing timber on January 1. All the timber that was harvested, we sold it on January 1 to the operator, who then went in and cut it and logged it and sent it to the mill and got paid. So that valuation date is January 1. That's a good news because January 1 generally is a high point in the market because it's middle of winter. There's not very many people logging in January, or it's late December, early January. And so there's generally a shortage then. And so it's not true all the time, but in many cases, the value is higher in January 1 than it is in May, June, July, August, when we're actually selling our logs to the mill. So how does this actually work? So we have these two owners. So let's look on the left-hand side of the slide. So as the timber owner, so because we're bringing in Section 1231, again, it doesn't matter if you're an investor or personal or business, you're going to use the Form 4797 because we're treating this as a sale of a 1231 asset by making the 631A election. So the sale price for the timber owner is that stumpage value of the timber that was harvested during the year as of January 1 of the year. So we have to get an appraisal of this. This is a deemed amount, and we want this number to be as high as it can be without getting red in the face. And the burden of proof is on you, the taxpayer, on that number. You're not required to get an appraisal, a third-party appraisal, but it is to your benefit to do so. And this is not the delivered log price. This is the price on the stump. So it's the delivered log price less logging, hauling, and maybe a profit and risk factor. But the thing to remember, it's not your sale price and your logging and hauling expenses. It's what a commercial timber owner like Weyerhaeuser would get for the timber and what they would pay for their logging. So which is generally, they're generally may get a higher price than you on the sale, and they probably were going to pay less than you on the logging and hauling because they are doing this on a commercial basis. And so it's not your costs, it's what the industry costs are. So that's the sale price. Your cost basis then is the depletion, your cost basis in your timber. And then the net of that is the 1231 gain. That's reported on the Form 4797. That's the timber owner side. On the log seller side, you're still going to pick up those gross receipts from the mill. You're going to pick it up now instead of on the front page of the 1040, if you were an investor or personal. You're now going to pick that up on Schedule C. So you're going to fill out a Schedule C and you're going to put the gross mill receipts as your income. And then you have your cost of goods sold, which is that stumpage value. So it's not the net amount, it's the gross stumpage value. It's not net of your depletion, it's the gross amount of what the stumpage value of the timber was, because you bought that standing timber, just like you went to your neighbor and bought their standing timber. That's your cost, minus then your harvest and sale expenses. So the cost of goods sold is your stumpage value plus the harvest cost, the logging and hauling, plus the sale expenses. And then we drop down, and then the operating expenses are deducted if you're a business taxpayer. So if you're not a business taxpayer, you're not allowed to deduct your operating expenses, right? So if you're an investor or personal, we have to capitalize them, or maybe they're miscellaneous itemized deduction or something. So you're not in business, but we're reporting the sale and the cost of goods sold, which you would have been entitled to anyway. So you're entitled to that, deduct the harvest and sale expenses. And then the net amount then is the ordinary income. Now, again, if you're a personal or a hobbyist, you can't take a loss on this, but if you're an investor, you can. If you're a passive trader business, the loss gets suspended. For active business, then the loss can be offset against your other income. So we talked about that last week. The net then is ordinary income. That's reported on, all this is reported on the Schedule C, or if, again, as we talked last time, if the timber activity is incidental to a farming operation, you can also report this on Schedule F. This is not self-employment income if you're a personal or an investor, because you're not in the trade or business, or even a hobbyist, because you're not in the trade or business of logging. But you may have to work with the tax software to have the Schedule C be excluded from your self-employment income. All right. So this deemed stumpage sale is a valuation exercise. Burden of proof is on you. And so I kind of, when I was doing taxes for people, I basically said, if it's under, if the gross sale is under $50,000, you know, take your best guess. It's not going to be worth paying somebody to come up with a better answer because the tax rate differential is not big enough. But if the sale amount is more than $50,000, it's probably you're going to get a benefit. It'll probably pay you to have an appraiser, somebody give you the value. Now, it's not going to cost near as much as a normal timber cruise because they're not going to go walk around the property. They don't have to take plots or anything. They're just going to look at the scale tickets, and if you can summarize them for them, or if you get the log accounting people at the mill to do that for you. So you have the species, the volume that was harvested by species and grade within the species. And that it becomes a pretty simple exercise then for the appraiser to say, okay, what was the stumpage value of this timber on January 1? We recognize the gain in the year that the timber is first measured. So again, as it's cut and then rolls across the scale, that's when we measure that. That's the timber is measured. We pick up the 631A gain for all the timber that was measured this year. So so the problem with this is, like, if you're logging late in the year, November, December, and so the stuff roll across the scale in November, December, but you didn't get paid until January or February. So we're going to pick up the capital gain. You've sold the stumpage, or pick up the capital gain and your depletion. But then we're going to pick up the cost when you receive, because that goes against on the Schedule C. You can pick up the cost when you actually sell the logs. So you sell some of the logs before the end of the year and some of the logs after. We basically have to do some accounting work to say, okay, you know, we sold 500,000 board feet. You know, 60% of it was before and 40% was after. So 60% of the 631A cost gets deducted this year on a Schedule C. 40% gets deducted next year on the Schedule C. We have to make a proper and binding election in order to claim 631A. Form T on page 2 or part 2, box 18A, the box you check says, I hereby make a 630, the election to treat the cutting of timber as a sale or exchange. You can also, you're required to actually attach the Form T with that box checked in order to claim the 630A. However, you can also attach a statement to the return. It says, I hereby elect under the provisions of 631A, treat the cutting of timber as a sale or exchange, and that will work also. So you can either through a statement or through the Form T, you have to make that election. Once you make that election, it is binding on all future years. So, and it's a good thing. It's something you'd want to do because you generally, you want to pay capital gains tax rather than ordinary income. If you're a Christmas tree grower, the stumpage value for those Christmas trees is the value at the beginning of the year. So it's basically last year's value. So you take the trees as they were last year and the prices for last year. Good news is there's a lot of market data because a lot of people are selling the stumpage of their Christmas trees. And so there's a lot of stumpage value data that's available on Christmas trees. You can also do kind of a conversion return valuation. So, but that's the deal on Christmas trees. So Christmas tree growers most of them, if they're selling the cut trees, they're using section 631A. If they're selling U-cut, they're using 631B. And you can do both. So it just depends on how you sell them. If you sell a U-cut and you have a lot where you're selling trees, you would have both 631A and 631B on the tax return. Got an example here. So we sold 300,000 board feet for $250,000. All the sale proceeds received in the current year, so no that allocation problem. The stand volume in the year of sale is 500,000 board feet. So our depletion basis in the property when we acquired the property was $24,000. So our depletion unit is $48 per thousand. So we take the $24,000 of depletion basis divided by all the timber that's standing on the tract. So 24,000 divided by 500 gives us $48 for every 1,000 board feet we take out. That's how much cost basis we get to apply. Our logging, hauling, and sale costs were $85,000. And the appraised stumpage value of that timber on January 1 was $175,000. So let's see how we would do this. So if we didn't use 631A, on either the Form 1040 or the Schedule C, depending on your classification, we would report the mill receipts, $250,000. You get to claim the deduction or the depletion, which is 300,000 board feet times our $48 a thousand. So that's $14,400 out of our $24,000. We get to deduct that. It's our cost basis. And then we've got our logging, hauling, and sales expenses of $85,000. So we would have $150,600 of ordinary income. You would just report that $150,600 as other income on the front page of the 1040. Or you would report all of those items gross on the Schedule C. So if you're on the front page of 1040, it's the net number. If you're using the Schedule C, you would report all of those numbers. So that's if we don't use 631A. What happens if we do? How does this change? So now we're two taxpayers. So the first one's a timber grower. The fair value of the stumpage was $175,000. So we have the $175,000 minus our depletion. We now have a capital gain of $160,600. And then on the Schedule C, we're going to report the mill receipts. And then we're going to take the fair market value of that stumpage, $175,000, because that's what we paid ourselves for the stumpage. That's a deduction. It's a cost of goods sold minus a logging, hauling, and sales costs. And now we've got a loss on the Schedule C of $10,000. That negative 10,000 plus the 160 is $150,600. So it's the same dollar amount of income we're reporting. We're just now, we've turned $150,000 of ordinary income into $160,000 of capital gain and a $10,000 loss. These things are added together for purposes of being able to deduct the loss. So even if you're a personal use taxpayer, you would be able to deduct that $10,000 loss because you have that $160,000 of income. Overall, you've got that income. And so that loss actually reduces your income from other sources. So it's a very powerful technique. And this is what normally you would want to see. You'd want to see a loss on the Schedule C and income on the 4797. If you don't see a loss in Schedule C, it's probably because the stumpage value number isn't big enough, and maybe you need to work with the appraiser or something to get a number that is a better number. Now, sometimes there'll be a market that opens up, an export market or something that occurs, it's unusual, and you actually end up paying taxes because the mill receipts that you got were more than what this timber actually was worth on January 1st. And so that does happen. Last thing to talk about here, sale of firewood and other products. So again, all these things are the sale of personal property. It's treated basically the same as the sale of logs. If we do sell, if we have logs that either we're using down to timber or we're cutting timber to sell these products, we can do 631A for this amount. Now, generally, unless you're in a really, really big operation, it's not worth the effort to do the valuation and all that to get this done. But 631A would be a possibility if timber, if you're cutting things, or actually if you're even using down timber, we can still use 631A for that. And you can also deduct depletion on those logs, on that timber that either was cut or blew over, whatever, and you cut it up. Generally, these numbers are so small that it's not worth messing around with, and you're just going to put the schedule, the sale of firewood, other things, either on a Schedule C if you're in the business of cutting firewood, or you're going to report it on the front page of the 1040 as other income, net of your net of depletion if you have any, the logging and hauling, and your sale expenses, but not any of your operating costs. And so you can't deduct the operating costs, but you can deduct basically the conversion costs of the logs. And with that, we're ready for some questions. So, Tammy, I'm sure there's been questions that have come up, and I can release this screen here.
Yep, that would be great. So yeah, you take a breather there for a second, Clint. So thanks for all of that. We'll start kind of from the top of the presentation and kind of work through it. So we're getting those older questions first.
Okay.
But one of the ones that came in that I did answer, just to give you a second, was about whether you could harvest timber on land with a conservation easement. And my answer on that was a very standard tax / economics answer of it depends, right? I know everybody hates when I do that, but it's reality when you're talking taxes. It's reality when you're talking about economics. And so the reason I say it depends is it really is a function of what that agreement looks like. And so if you're thinking about a conservation easement, you need to be talking to the organization and understanding their goals and their objectives. They may not want harvesting done. They may allow some harvesting, but not a clear cut. And so it's really just kind of understanding the objectives of the two parties that are involved in this. This really is a transaction. And so having that conversation before you sign the dotted line, even if they're waving money in your face or that donation sounds really great, you've got to understand these are bundles of rights that go with your land above and below. And what we're talking about is what rights are you giving up? That's what's in that document. And then what are you retaining, including the rights to harvest or do any particular cultural treatments on your property. So that's the one I answered for you, but I wanted to go ahead and say it.
Great.
So along the lines of the conservation easement, this one came in about the Bonneville Tower transmission towers on our property, but we get no reimbursement for the easement, but our restricted use for that portion. And when they bought the property, the towers were in place. Yeah. And the question is whether there's any tax value there.
Yeah. So the person, actually, we have one going across our property, 33 acres. It's huge. I think we got paid. But we got paid. I mean, we were the owner when they brought the lines across. I don't know. I think we got $10,000 or something for it. Back in the 50s or 60s when they put those lines in. So no, you got paid once and it's there now, and so. And it's a challenge because you can't do it really. You can't do very much under the easement. You can't grow trees under it. In fact, if you did, trees all go wonky because of all the RF energy in the air. You can run cows under it. We actually have a paintball field or paintball course for our kids and grandkids to use. But yeah, it is what it is.
Yeah. The question that wasn't asked, and we'll talk about property tax related stuff towards the end of this. But that's where I've heard that question come up is, should that be a different, and this was asked to an assessor, I want to say Douglas County or somewhere along that. But that was the question is, could we get a different property classification? Because basically if you don't have the use of the property underneath that line, you effectively shouldn't be getting taxed at the same level as if you had all the use of it. And so that's kind of probably the more appropriate discussion from a tax standpoint.
And I think really this depends on your assessor. Here in Lynn County, they will do things like that. So in fact, I think we have said, here's this land, it's unproductive. So they classified it as FX, basically said it's like a rock outcropping or something, can't grow trees. There's other assessors that are not quite that generous. And so it's really a matter of your assessor.
Yeah, and I think sometimes you just have to ask, right? So if it's being taxed as forest land, and it's any kind of significant acreage, you need to go have that conversation. If you don't ask, you can't have it, right? And tell my kids that you got to ask sometimes. All right, so I'm not really sure how I want to categorize this next one, so I'll just give it to you. Speak to a house / or home on family forest land property that's in an LLC. Can the house be rented as a home or as a vacation rental? And then can the renters be members of the LLC?
Yes. So this is a real challenge because, yeah, so once the house is inside an entity, even if it's so it's like a credit shelter trust or something. So a living trust is okay, but if it's held by an irrevocable trust or an LLC or something, you lose that ability for the $250,000, $500,000 exclusion. So Section 121 only applies to property that's held by an individual who lives in it. So, but once the property's in the LLC, yes, you can rent it, and people can pay rent. That rental income, and that turns it into rental property. The real challenge, if you have family members using it, is the amount of, is it a fair market value rent? So if it's a below fair market value rent, you basically can deduct costs up to the amount of rent, but you can't have a loss. But if you have a fair market value rent, it's just like you have any other rental property. It's passive income, passive loss if you have a loss operating it, and you can deduct losses, or have losses. Those losses will not, I mean, it'll actually be reported on that LLC on a different line. You're gonna have your income from the tree farm on one line, and then you're gonna have your net income or loss from the rental property on a separate line, so that the individual taxpayers pick it up that way. But no, it's absolutely possible. You should be, if you have a house on the property, it should be either generating income or being used by someone who is managing the property, or doing fire watch or doing something. But yeah, it's a great source of annual income to help pay property taxes and your annual operating costs. That rental income is a great thing to have. And so it doesn't matter if it's family members or not, but if you have family members on it, you have to spend a little bit more time thinking about what is the fair market value of the rent, which can include some compensation element for them working there. So, but that's a more complex question, something to direct to your tax professionals. But it absolutely is something you should be looking at and doing. And if it's a family member, you do need to look at trying to identify what the fair value of that rental is and staying pretty close to that number. It can be at the low end of the range, but it needs to be something, again, you don't get red-faced when you're across the desk from the steely-eyed auditor saying, what are you doing?
Yeah, absolutely. Making sure you can justify what you've done. So, all right. So I'm going to read this one. Personal property burned during the fires in Douglas County. The electric company said I had to let them cut the trees away from the power lines going back up. I have 3 acres that was timbered. So the electric company cut down 1.5 of those below the trees, or 1.5 acres. I decided to have the rest cut by a local logger. So about half and half. Okay. All the cut trees from them, and the electric company cutting were sold to local mills. So all the trees, whether required or not, were sold. The local logger charged half of what the trees were sold for. Do I pay taxes on what he took away?
Yes.
And whether, and then if you'll classify that income as well.
So so in this case, so we can talk about, you're probably not going to have a casualty loss because your basis in these trees is going to be next to nothing. And the reality is you're not going to be able to find an appraiser and it'd be cost way too much anyway. So you're not going to even deal with the casualty loss stuff. And so this is part of your personal residence. You're going to be a personal use taxpayer. You would take the gross amount that you receive, net of your logging costs, and it's going to go on page 1 of your tax return as other income.
Great. All right. The forms you refer to are all with 1040. What about schedules for Form 1065 for a family LLC?
Yeah. So for family LLC, all the Schedule C stuff is on the front page. That's your business income And so if you're 1065 or 1120S, a subchapter S corporation, all of your business income is going to be reported on the front page of the return. So that's all of your business income. That's where it's going to go, and that will be reported out as business income. You're still going to use the form 4797 for the other part, because it's sale of business property. That form is used by all taxpayers.
And so here's another form related question, kind of, sort of. What is the taxpayer classification to use a Schedule C?
So Schedule C is used by somebody that's in the trade or business of logging or raising timber. So it's a business schedule used by people that are in the business, and so if we look back at the last week's section on classification, that'll give you a better idea. Now, if you use section 631A, if you make that election, then you will use the Schedule C to report your timber sale income, regardless of what type of entity you are. But if you're not in business, the only things that you'll put on the Schedule C are the gross receipts minus your cost of goods sold, which are your logging and hauling, your sale expenses, and your and the 631A amount. The amount that you had that deemed sale that occurred in January.
So while we're talking about 631A, this brings up a good question, and I'm going to answer a little bit and see if you have any other suggestions. But the question was, where do you find stumpage values now that ODF doesn't provide them anymore? So in the past, we tell people go to ODF. They've got this nice history of numbers, and of course, those numbers are still out there, and some people have downloaded that information. I would tell people right now to go talk to a consulting forester. Consulting foresters, they're more local to where you're at, and so they're going to have prices that they've seen within a local area. Sometimes we see that extension folks have kind of a little bit of a database going of things that they've collected where they've seen prices listed. But Clint, where would you go looking for stumpage prices now?
Yeah, so I basically have three answers. So the first answer, and it depends on the size of the sale. So if it's, I said again, if the gross proceeds from the sale are under 50,000 bucks, I think you just take your best guess. You look at what you might call a couple mills and say, what were you paying for the logs back in January, and then take some number, whether it's a percentage, 35%, or logging and hauling costs, and deduct that from it and use that number. If you're off by 10 or 20% on what that number is, it's not going to make a big enough difference in your tax return that IRS is going to care. Okay. You go from about 50,000 up to maybe, I don't know, a couple $100,000, or maybe even $500,000. And I would go to consulting forester. And because you're not looking at just the local market, I mean, you're looking at export, you're looking at, you want to have valuation for a large one. And so they're going to be, so you're going to want to have that valuation number. And again, you're going to provide them with the scale tickets and all that. So they're going to have that information. And my experience on this is, it's hundreds of dollars, not thousands of dollars for this appraisal work. So I've got actually in your materials kind of, what it, how much you'd have to move the needle, a little calculation there on the bottom of on the middle of page 11. So, if you have $1,000 appraisal cost, you probably, if you can move the number by $5,000, you've paid the $1,000 appraisal cost. And so you have to have a kind of a big enough thing to be able to move the needle enough to pay for the cost. But you're going to probably make money by hiring an appraiser. If you have a large sale, 750,000 million, thing, you're going to want to go to one of the big companies. There's a guy named Vic Musselman up in Washington that just does 631A appraisals. They specialize in this. He has an economic model. It's not just spot prices. He takes kind of from June to June and kind of moves the numbers, and so again, you want to have this number be as big as it can be and not get red in the face of the IRS. And And so the larger the number, the larger your sale amount is, the more you can afford to spend on getting a good appraisal, because it's going to save you. You're going to be dollars ahead getting it done that way.
Yeah, and I think a couple of things to add. If you already have a consulting forester working on your property, then that's the easy answer, right? But the other thing is they're not expecting it to be exact, right? I mean, we're trying to look at what would happen for a sale that's not physically happening at the beginning of the year for that 631A. And so you're really trying to get an idea of something that would happen, right? And so you're doing your best, again, like Clint said, and being able to look at an auditor in the face and not have him probe any deeper.
And just remember, this is an appraisal. So appraisal is there's a range of value, right? From a low number to a high number. And so it's what the definition of fair value is what a willing buyer and a willing seller, both being fully aware of the facts and neither under the compulsion to buy or sell, would enter into a transaction. And so in that number, you may have a neighbor that will pay a lot more for it than somebody else because they have other reasons to buy this than somebody else would. And so it is a range. We don't want to put pennies on an appraisal. You don't probably even want to put dollars. You probably need to be rounded off to the nearest 500 or $1,000, because it's like there's an azimuth on the moon. We had 2 decimal places to it. It is an approximation. It is an estimate of value, and it's not, it's going to be based on real life transactions. But it is so if we're doing like for gift or estate taxes, we look at that value and we basically tell the appraisers we want to be on the low end, right? Because we're going to pay taxes on whatever that number ends up being. In this case, I always make sure you tell people this is for the 631A appraisal, and we want this number to be as high. Again, it's a range, and as you're looking at that range, we want to have the number be as high as you can justify in that range. Because generally when appraisers are doing this, they're trying to they're looking at the other side. Basically, most people will say, well, I want this appraisal to be as low as you can make it and still not get red in the face and still be able to defend the number.
All right, so we have a couple more, and one of them is about tax advantage of reporting sale of logs as a business rather than an investor. It's got some question here about the expenses related to the sale, and I think we'll probably cover that in a subsequent one. So really the advantage of, or if there's an advantage, reporting sales of logs as a business rather than an investor.
In terms of the sales side, no. Where the big advantage of them being involved, having it classified as a business versus an investor, is the ability to deduct expenses. As an investor, you can't deduct any of your expenses for operating the tree farm except your property taxes, which are limited to $10,000 overall on your Schedule A, and potentially your mortgage interest if you've borrowed money against the property. No other operating costs can be deducted if you're an investor. If you're a business owner, you can deduct all your operating costs. You can buy equipment. You want to get a gator or a dozer or something and use on the property. You're buying a power saw. You have power saw gas. You've got your insurance. All those things. If you're a business owner, you can deduct those things. If you're an investor, your OSWA dues, going to tree school, all those things are deductible. If you're a business owner, if you're an investor, none of those things are deductible.
I should be clear that the expenses were related to the sale, and of course, those are going to come off the sale.
So the sale, if it's related to the sale, those expenses are deducted either way. You can deduct those sale expenses no matter what kind of taxpayer you are. You may not be able to claim a loss, but if you're investing and you're looking at this, you can deduct those sale expenses. So the appraisal fees, the marketing costs, all those costs related to the sale, as well as logging and hauling, all those costs are deductible no matter what type of a business, what type of classification you have.
I think you can answer this one quick. Somebody's being audited on a U-Cut Christmas tree farm business. How long can the Oregon IRS take to complete their review, and how far can they go back in an audit?
Okay, very good question. So we have a statute of limitations. It's 3 years. 3 years from the date you file the return. So you file a return today. or you file it April 15 of 2021, they can open up the audit up to 3 years from the time you file. And if they do have, if they have opened up an audit, they can pick up all of the open returns. So if you're picking up an audit today, they can pick up your returns back for 3 years and make you change. If they see you've done something wrong and you've done it wrong consistently, they can correct the last 3 years. That's if they think that it's just an honest error. If they think you've committed fraud, that you knowingly filled out your returns wrong, then they can go back 7 years. And then they've also got criminal penalties and other things too. So the difference between tax avoidance and tax evasion is 15 to 20 years. And you measured for stripes and things like that. But if they think there's fraud going on, then they can go back 7 years plus assess criminal penalties. But normally it's 3 years.
And then the last question we have, for a pay-as-cut contract, how is the volume measured? I'm guessing that's when the volume is measured.
Yeah. So pay-as-cut contract, you get paid basically as the trees come out of the woods, so when they roll across the scale. So that's different from a lump sum sale where you basically, everybody kind of takes their best guess of how much timber is there, and then they just write you a check. In the pay-as-cut contract, that you get paid as the timber is measured and comes out of the woods. Or like if it's a you-cut Christmas tree and you're charging $10 a tree or whatever, and you get paid as they cut the tree and take it to their car.
Great, thank you.
Thank you, Tammy, for putting that all together.
Sure thing.
Clint, do you have any closing comments for today?
No, great. I appreciate everybody being part of this. Appreciate your comments. So if you do have questions between sessions, please, reply to Mike or myself. We'll be happy to answer and get back to you. If it's something we think, hey, we screwed up here, or something that's more general knowledge, we'll bring it up next time we get together. I'm excited about our next session on expenses. And so I'm looking forward to having you all back, and bring your friends and let other people know about what we're doing here.
Great, thanks, Clint. Great job today. Yeah, like you said, back on April 13th for deducting expenses. This is also just a reminder that this is an Oregon Small Woodlands Association Forestry Taxation Series. These webinars are brought to you by Clint and Tammy, along with Mike Clausey from OFRI, and of course myself. We really appreciate everybody attending these, and we've had a great turnout so far. I just posted the link to the website again in the chat, so if you have missed any other sessions or you want to get these slides or these handouts, those are available to download today on there. Later this evening, this video recording from today will also be posted on there. These events are all only possible through your membership with the Oregon Small Woodlands Association, so thank you to OSWA members. And thank you all, and have a great afternoon.